If you're running a construction business in Canada, financing new equipment can feel like this constant, nagging headache. But what if you could flip that script? What if that headache could actually become a major strategic advantage? Well, in this explainer, we're going to break down exactly how to do that. We're turning a necessary evil into a powerful tool for your growth. So, does this sound familiar? You look at your books and everything looks great. The pipeline is packed with projects, your margins are solid, but then you go to make payroll and the bank account is, dangerously low. This gap between being profitable and actually having cash in the bank is probably one of the biggest hurdles in the entire Canadian construction industry. And look, this isn't just a gut feeling. It's backed up by some pretty sobering stats. The Canadian Construction Association found that a staggering 80% of construction business failures aren't because there's a lack of work. Nope, they're caused by cash flow problems. So what's really at the heart of this cash crunch? Well, it all comes down to something we call the contractor's cash flow trap. You see, there are these structural issues that are literally built right into the way the industry works, and they put a constant squeeze on your money. So let's pull back the curtain and see exactly what's going on. It's really a vicious cycle, and it's got three main villains. First, you've got to pay for everything, your crew, your materials, all of it right up front. Then, villain number two, you wait, and you wait, and you wait, sometimes 30, 60, even 90 days to get paid by your client. And for the final blow, villain number three, a massive chunk of your cash gets locked away in something called holdbacks. So what in the world is a holdback? Well, in Canada, it's a mandatory 10% of every single payment that your clients have to withhold until the project is pretty much done. Now, it's supposed to protect them, but for you, it often means your entire profit margin is held hostage for months. And here's a real kicker. You still have to pay taxes on that money, even though it's nowhere near your bank account. It's crazy. Okay, so that's the bad news. These problems are just baked into the system. But the good news? They are not unsolvable. Just like it says here, you can't really change the industry, but you absolutely can change how you manage your cash flow to navigate these challenges. Let's get into the tools that let you do just that. First up, let's talk about something that just makes sense: aligning your financing with the seasons. We all know that in Canada, construction is a business of peaks and valleys. Revenue is flying high in the summer and takes a nosedive in the winter. So why on earth should your loan payments be the same flat amount every single month? You can really see the massive difference right here. On the left, you've got that standard payment plan, and it's just a constant drain on your cash during those slow winter months. But look at the right. A seasonal plan actually mirrors your reality. Your payments are higher when the cash is flowing in and way lower, or sometimes even zero, during the off-season. This keeps your capital right where you need it most. And this isn't a one-size-fits-all kind of thing. There's a whole toolkit of flexible payment options out there. You've got seasonal payments that we just talked about, skip payments that let you completely miss a payment in a slow month, step-up payments that start low and grow as a project ramps up, and deferred payments that give you a nice grace period at the start. The key takeaway here is that you can actually design a payment plan that fits your specific needs. All right, so we've got our payments matched up with the seasons. That's a huge win. Now, let's tackle that other big problem. How do we unlock all that cash that's trapped in our outstanding invoices? This is how we bridge that painful 30 to 90-day gap between doing the work and actually getting paid for it. This is where a really cool service called Construction Invoice Factoring comes into play. Now, this is important. It is not a loan. It's a service where a company essentially buys your approved outstanding invoices from you for a small fee. You get your cash almost right away, and they take on the job of collecting from your client. It literally turns your unpaid invoices into cash you can use today. Now, putting invoice financing aside for a second, when it comes time to actually get the equipment, you've got a fundamental choice. Do you get a loan or do you lease it? And honestly, the right answer just depends on your goal. As you can see, if you want to own the asset for the long haul, a loan is the way to go. But if your goal is just to use the equipment for a while with lower payments, an operating lease is often the smarter move. You just have to decide, are you playing the ownership game or the cash flow game? Okay, let's talk about a hidden superpower that a lot of businesses just completely overlook, and that's strategic tax optimization. Thanks to some recent changes by the Canadian government, there's now a massive opportunity for construction companies that are buying new equipment. It all centers on this thing called the Capital Cost Allowance, or CCA. The easiest way to think about it is like this. When you buy a big, expensive piece of equipment, the government knows you can't take that entire financial hit in 1 year. So the CCA is the system they created that lets you deduct a piece of that cost from your taxable income each year. It basically lowers your tax bill over the life of the asset. So, just how powerful is this? Well, thanks to some brand new immediate expensing rules, the impact is, well, it's staggering. A business in a 25% tax bracket that buys $1 million worth of equipment can get a first-year tax savings of $250,000. Just let that sink in for a second. That is $250,000 in cash back in your business in year one. And you can see on this chart just how massive that change really is. Look, on a $200,000 piece of gear, the old rules would only let you write off about $30,000 in the first year. Then the government introduced an accelerated incentive to boost that a bit. But now, with 100% immediate expensing, you get to write off the entire $200,000 in year one. It's not just a little improvement, it is a complete game changer for your immediate cash flow. So we've covered a lot of ground, right? We've talked about seasonal payments, we've talked about invoice financing, and we've talked about these incredible tax strategies. Now let's pull all of these pieces together into a simple, straightforward blueprint for building a much stronger business. Your strategic blueprint really comes down to these three key actions. First, you've got to align your equipment payments with your busy and slow seasons to protect your cash flow. Second, use tools like invoice factoring to turn those unpaid invoices into cash you can use right now. And third, work with your accountant to make sure you're taking full advantage of these powerful new government tax deductions. These 3 steps, this is your path out of the cash flow trap. And all of that brings us to our final question, which is really a shift in thinking. It's time to stop looking at your equipment as just another line item expense. Because when you manage it the right way, with the right financing and the right tax strategy, your fleet can become one of the most powerful financial tools you have for building a stronger, more profitable business.